Welcome, everyone. Today, we've got an absolutely essential explainer lined up for you. Whether you're a chartered accountant, a tax professional, a business owner, or a student preparing for exams, you're going to want to pay close attention. We're breaking down one of the most critical pillars of the brand new Income Tax Act 2025, Section 161. This is the big one. It governs the computation of income from international and specified domestic transactions, zeroing in on the arm's length price. Transfer pricing is always a high-stakes, highly scrutinized area, and understanding exactly how it operates under this modernized 2025 framework is just vital for your practice and your businesses.
To set the stage, let me throw a practical scenario your way. Let's say you want to sell goods or services to your very own foreign subsidiary at, a massive 50% discount. Can you do it? Well, commercially, sure. Between related parties, you might really want to do exactly that to help them out. But from a taxation standpoint, no way. The tax department will absolutely have something to say about it. Why? Because if you heavily discount that sale, you're artificially lowering your profits right here in India, which means you're paying less tax to the Indian government. This is exactly why transfer pricing scrutiny exists in the first place, and it's the exact type of behavior Section 161 is designed to regulate.
Okay, let's dive into this. Here is our roadmap for today's explainer. 1. Introduction to Section 161. 2. The arm's length principle. 3. A practical transfer pricing example. 4. Compliance and mandatory forms. 5. Common issues and mistakes. And 6. We'll wrap it up with a summary and key takeaways.
Section 1. Introduction to Section 161, Bridging the Acts.
For the seasoned KAs and professionals watching, don't worry. The core philosophy of transfer pricing hasn't been completely rewritten. But its address in the rulebook and the terminology, that certainly has changed. What you used to know like the back of your hand as Section 92 under the old 1961 Act, well, that maps directly to Section 161 in the 2025 Act. The primary goal is identical, ensuring that transactions between associated enterprises are recorded at a fair, market-driven price so India's tax base isn't eroded. But listen, the most profound shift here isn't just the section number, it's the timeline, terminology. We are officially saying goodbye to the concept of the assessment year.
Now, what's really interesting about this slide is how it simplifies our lives. Under the 1961 Act, we had the previous year, when the income was actually earned, and then the assessment year, when it was taxed. And honestly, that caused endless confusion for clients. But as the new guidance notes explicitly detail, the 2025 Act cleans this right up. The year the income is earned and the year it's assessed now share a single, unified reference, the tax year. So, income earned from April 1st, 2026 onwards is governed by the 2025 Act and is simply assessed as tax year 2026-27. No missing years, no weird overlaps, just one clean term. You've got to keep this in mind, because all our transfer pricing compliances now completely revolve around this new tax year concept.
Section 2. The Arm's Length Principle, Core Legal Provisions.
So, Section 161 lays down the law. Any income, expense, or interest arising from an international transaction or a specified domestic transaction has to be determined having regard to the arm's length price. But what exactly are these transactions? Section 163 tells us an international transaction is one between two or more associated enterprises, where at least one of those parties is a non-resident. This covers buying or selling property, intangibles like patents, or providing services. But here's the kicker. The transaction must have a bearing on the profits, income, losses, or assets of the enterprises. Then you have Section 164, which covers specified domestic transactions. These are very similar, but happen entirely within India. They often involve tax holidays or specific domestic structures where profit shifting is a major risk.
Right, so what is this elusive standard we have to meet? Section 173A defines the arm's length price, or ALP. Simply put, it's the price that would be charged in a transaction between two entirely unrelated, independent parties operating in open, uncontrolled market conditions. It basically strips away the special relationship between the associated enterprises. If you sell a product to your foreign subsidiary, the arm's length price is the price you would have charged a random independent buyer on the open market. It's leveling the playing field.
Of course, finding that exact open market price isn't always a walk in the park. That's exactly why Section 165, when read with Rule 79 of the Income Tax Rules 2026, gives us specific methods to calculate the ALP. You've got the comparable uncontrolled price method, the resale price method, the cost plus method, the profit split method, the highly popular transactional net margin method, often called TNMM, and other methods prescribed by the board. Now, the law is very clear here. Taxpayers can't just pick whichever method gives them the best tax result. You have to select the most appropriate method. And choosing that depends on the nature of the transaction, the reliability of your data, and a deep, detailed functional analysis of the assets employed and the risks assumed.
Section 3. Practical Transfer Pricing Example. Applying the law.
And this brilliantly illustrates how an adjustment actually works in practice, pulled straight from the guidance notes. Imagine an Indian company provides administrative services to its foreign associated enterprise. In their books of account, they record the value of these services at $1,100. However, after applying the most appropriate method under Section 165, the tax professional determines that the true arm's length price, what they should have charged a third party, is actually $1,200. Because this transaction generates income for the Indian entity, a transfer pricing adjustment is absolutely warranted. You have to add that $100 adjustment back to the book value, which brings the final computed arm's length price to $1,200. This ensures that the Indian tax base captures the full, fair value of the services provided.
Section 4. Compliance and Mandatory Forms. Rule 84 and beyond. Moving into compliance, Rule 84 is literally the cornerstone of your transfer pricing defense. Every person entering into these transactions has to maintain exhaustive documentation. And guys, we aren't just talking about keeping a few invoices in a file. You need to document the entire ownership structure, the profile of the multinational group, a highly detailed functional analysis of risks and assets, comprehensive economic and market analyses, and your record of comparable uncontrolled transactions. And here is a critical compliance detail you absolutely cannot afford to miss. Under the new rules, all of this information and documentation must be safely retained for a period of 9 years from the end of the relevant tax year. 9 years.
Then we have the mandatory forms. Section 172 requires an accountant's report, and this is now filed as Form No. 48, which officially replaces the old Form 3CEB. This new form is a massive game changer. The tax department realized that the old forms lacked standard formatting, so Form 48 shifts completely away from narrative text. Instead, it demands highly structured, transaction-wise digital reporting across parts A through F. It uses drop-downs and standardized categories, meaning it captures the key elements of your economic analysis digitally. Also, if an SSC wants to opt for multi-year ALP determination in a single proceeding under Section 166(9), they'll use Form No. 46, accompanied by an accountant certificate in Form No. 47.
Section 5. Common Issues and Mistakes.
So, the crucial point is that you need to adapt your practice to these updates immediately to avoid some really common pitfalls. The biggest initial mistake? Confusion over terminology. You have to remember, the assessment year is gone. Everything operates on the tax year now. Second, while international transactions always get the spotlight, please don't ignore specified domestic transactions under Section 164. They are equally subject to ALP scrutiny. Third, watch out for improper mathematical adjustments. As we saw in our example, if the transaction is income, an upward adjustment adds to it. If it's an expense, the adjustment reduces the allowable expense. And finally, with Form 48, you just can't rely on vague narrative descriptions anymore. Your data has to fit the new digital standardized dropdowns, which means your underlying comparability analysis must be more precise than ever before.
Section 6. Summary and Key Takeaways.
Let's do a quick rapid-fire recap. Section 161 of the 2025 Act replaces Section 92, moving us seamlessly into the new tax year era. Whether it's an international or a specified domestic transaction, if it's with an associated enterprise, it must be priced at an arm's length price. You determine this price using the most appropriate of the 6 methods under Section 165 and Rule 79. Your compliance relies heavily on Form 48, which demands highly structured digital reporting. And remember, your supporting documentation under Rule 84 must be retained safely for 9 long years. Looking at these stringent new structured reporting requirements, I want to leave you with this thought. Are your intercompany pricing models truly ready for the digital transparency of the 2025 Act?
Thank you for watching. Please like, subscribe, and share. And as a quick reminder, this explainer is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments, so please consult your professional advisor before taking any action. This is an AI-generated educational explainer. Stay informed, stay compliant, and we'll see you next time.